Welcome to the Anchor Your Retirement podcast. I'm your host, Barbara Gullen, with my co host, Tony Shore. Tony, I feel like I haven't seen you in weeks.
Oh, it has been a couple of weeks
It
anyway.
has
Yeah.
been. It has
Yeah.
been.
I was out last week. What was I doing last week? Oh, yeah, I was camping out for a record store day.
Record store day. Yes.
I took the day off to prepare for record store day.
It's like
Um,
your Christmas, isn't it?
it is. And my son and I went and camped out with all our buddies. It's usually the same 10 people that like to be first in line to get all the exclusive releases. I even picked up the exclusive Taylor Swift 7-inch for you.
Yes. And thank you very much. I got that. It is now sitting in a place of honor at my
Yep.
future home.
Yes.
So, yes,
Yep.
because we are on the countdown 11 weeks from tomorrow. I say I do. So,
Oh, wow.
lots
11
going
weeks.
on.
11 weeks to the wedding.
11 weeks to the wedding.
All
But
right. Are
nobody
you
really
ready?
cares about that. Yeah, I actually am. The wedding is going to be like one of the easiest weddings ever.
You're having you're not going crazy. It's a
No, it's just
simple,
family. It's just
just
family.
family. That's good. Yeah.
Family, and then a little bit of a vacation after that. So,
Nice.
but
Nice.
you know,
Congratulations. I'm so happy for you because I know
thanks.
Eric. I've met Eric. I've hung out with Eric, and you are one lucky person, Barb. He
I
is
am.
fantastic.
I
mean,
am. He's a gem.
you found a winner there. Winner,
Yes.
winner, chicken dinner.
Yeah.
And he's able to put up with you and all your craziness. I'm
Well,
Bonus.
I have my
Bonus.
quirks. I have quirks.
We were talking about that before the show, how everyone does, right?
Yes.
Yeah, we all have our quirks.
Yes. And
I
if
love
you
it
look
when
hard enough, everybody's got their own little set of DSM diagnoses. But
Oh, for sure. We're all on the spectrum somewhere. We're all a little ADD in one way or another, right?
yes. And it's probably a good thing you didn't talk to me the week before, because I was really, really kind of depressed.
Oh, I'm sorry.
Yeah. Because I ended up having to write a larger check than I planned on writing to the IRS.
Oh, tax day. Hit.
Tax day. Because, April 15th is a kicker for those of us that have to make estimated payments, because you have to pay the taxes that are due for 2025. And then you have to make that first installment for the next year on the same day. So that was a painful day for my checking account.
Well, yeah,
As a
that's
responsible
tough.
citizen, you have to do those things.
That's tough. Yeah, and my wife and I, we owed a little bit, and it's just a little bit more than we were expecting. We're trying to get it as close to zero as possible. We thought we had worked it out.
As you should.
We thought we had worked it out, so we were a little surprised, but it wasn't too bad. So
honestly, I'd rather see you owe than getting a refund, because when you get a refund, you're actually giving the government money for them to use interest free.
yeah, basically the government's using your money or earning interest on your money. Well, you're not.
They're
That
so
money
far
could be
indebted
working.
out there
Yeah,
earning much
yeah,
interest.
yeah, exactly. So I would rather not get back, but I'd also rather not owe. But it's hard to hit that sweet spot. But I think we're meeting with our buddy, Joe Norden. He's going to help us. He's going to help us get there.
Oh, he's such a great guy.
Yeah, we're meeting with him on the side, and he's a tax expert, and so he's going to look at our situation and say, here's what you need to do for next year to come out even.
We should actually have him on the podcast at some point.
We should, and he's so much fun. He's one of the greatest guys, and he is a tax expert. I mean, he knows his stuff when it comes to taxes. So maybe between now and next tax season, we'll have him on to talk about that.
It's very seldom that you find somebody that's that astute with taxes that is that good with having a personality as well.
Yeah, that's actually fun to talk to and can actually communicate. Yeah. Sometimes accountants aren't so good. But my daughter is an accountant, like a forensic accountant. She does auditing of she audits nonprofits for one of the big 3 tax or accounting firms, and she's great. She has a great personality and loves people. So
yes,
she loves people more than she loves accounting, but yet that's her specialty, and she's just so smart with numbers. So
it works.
Yeah,
it works.
Yeah.
But there are a lot of people who go into retirement not realizing that they could end up paying more in taxes than they anticipate. There's headlines, the one big beautiful bill, once you're 65 or older, you get this extra $6,000 mulligan, we'll call it, with taxes when you're collecting Social Security. But a lot of people are so diligent about saving.
Mhm.
And when they have that frugal lifestyle and that frugal mentality, when it's time to move into retirement, they can be a little bit afraid to spend the money. So they continue to let it sit there and grow. But then when it's growing tax deferred, I'm talking about your pre-tax dollars.
Sure.
Once you reach the age that you have to take those required minimum distributions, right now it's either 73 or 75 years old, depending on whether or not you were born before or after 1960. They can end up having to pull a bunch of money out that they weren't planning on pulling out, don't need because of the lifestyle that they're living, and then they get stuck paying taxes on it.
Yeah, exactly, and I think that, it's a ticking tax time bomb, as we've heard, some of these
It is.
accounts. So many people have all of their 100% of retirement money in 401ks or traditional IRAs, traditional 401ks or 403(b)s or TSPs,
Mhm.
and what they don't realize is those are tax-deferred accounts that they're going to have to pay on later, and if they need to pull money out for something in retirement, they're not thinking of that either. "Oh, well, we're gonna pull money out to buy an RV." Well, you might wanna put that on payments, because if you pull all that money out at once,
Right.
you're in a higher tax bracket, and that
And
really affects a lot of other things too,
it
doesn't it?
it does, because now with how your Medicare Part B premium is structured, that is income based. It has been for the last several years. But if your adjusted gross income exceeds whatever the threshold is that year,
Mhm.
then you end up having to pay, right now it's $200 and
202.
change. I couldn't remember if it was
It's
202.
$202 a month, and people hear that figure and they think, "Well, that's what it is for everyone." No.
No, no.
If you have taxable income above, I forget what it is, 180 or something that
Well, and
particular
it
year.
changes every year, and it's
Yeah,
different if you're single versus married,
right.
and, because the tax code is not made to be
It's messy,
simple. It's
and that's called
messy, it's
IRMA. That's
complicated.
I call that Aunt Irma. IRMA is
Yes,
they call it a surcharge, but really it's a tax or a penalty,
it is.
uh, and it can go up to Barb, I was just reading about this and I couldn't believe it. So, your Medicare Part B premium, instead of 202, can go up well over $600 a month if
It
you
can,
exceed that,
it can.
threshold. So taxable income in retirement is a problem for some people, right?
It really is, and, I mean, if your adjusted gross income for a couple goes over $750,000, then you're paying $689 a month. But if your adjusted gross income as a couple goes over $218,000, you go from 202 to 284.
Wow, that's crazy. And
And
it keeps going up from there, doesn't it?
it does. It does. Again, if you are fortunate enough to make more than $274,000 in a year, you're paying $405 a month.
Wow.
And there are mechanisms where you can file an appeal. If it was a one-time thing where you sold a house and ended up with, sold a rental property where you had that income that was realized as capital gain, you can usually file an appeal and get it reduced when they see that it's like a blip on the radar and not a real thing. Or a lot of single people, it's more of my single clients that end up feeling the impact of that than my married clients do, where while they were working, they were making above the limit and get into that second or third tier where they would have to pay it. And when they are on their pension and Social Security, they have a much lower income by then. So because when they start looking at IRMA, they look back from 2 years.
Sure.
They
So there's a look back. They're not pulling it from this year. They're pulling it from 2
Right.
years ago. So what happens is you might get bumped up into a higher tax bracket during retirement for one reason or another, or your
Mhm.
RMDs kick in from your tax deferred accounts, and the government makes you start taking distributions and paying full taxes on that. That could bump you up into a higher tax bracket. And then 2 years later, you're still paying the 202 a month or whatever it is that year, changes
Mhm.
every year. And then a couple of years later, all of a sudden, boom, your Medicare premiums go up, and you're like, "Hey, wait, what happened?"
Yes. Yes. So, it even if you've done a really good job of saving and think that you're going to be okay financially and you've done it yourself, props to you. There are a lot of people that made it their hobby while they were working to manage their investments.
Sure,
And I think really that's just an act of good stewardship. I would never
sure.
criticize that at all. But as you're moving into these distribution years, as you are moving into that place where things get more complicated and you don't even realize they're about to get more complicated. That's when having a fiduciary and somebody who has some experience with tax mitigation can help you head it off at the pass, or at least take away a little bit of the sting by helping you realize where you are in the brackets and what can be done within those bracket constraints to help you create a more tax efficient retirement down the road and ultimately pay less in taxes over time.
Boom, and there it is, and you're right, Barb, because, most people don't realize that taxes in retirement are going to be one of their biggest expenses,
It really
and
can
they
be.
think, "Well, I'm not working anymore, I'm gonna pay less in tax, I'm not worried about taxes," but yet all their money is, a lot of their money is in a 401k or a traditional IRA, and that's all fully
Mhm.
taxable. So how the income is created, I know a big part of what you do, Barb, is to minimize that future tax burden for your clients as part of their retirement income plan. Part of that plan is minimizing their tax burden in retirement. So, how can people pay less to the IRS? What are some of the ways that and strategies that you utilize? I know everybody's situation is
Yeah,
different and time
everybody's
horizon.
situation is different. And, even though I'm presenting these scenarios, I want to make it really clear I'm not telling anybody to do anything without consulting with an advisor,
Yes,
preferably a fiduciary who understands some of the ins and outs and nuances of taxes and
right.
IRMA and the repercussions of things. But there are a lot of dinner seminars that are being offered talking about Roth conversions and delaying Social Security. And you know what? If you delay Social Security, you're still not delaying Medicare. And in fact, you're then paying for your Medicare premiums out of pocket until you start drawing Social Security.
Sure.
Um, you know, again, it's another bill to pay. It's something else that you need to stay on top of and keep track of. Nobody really that I've ever talked to said that I'm retiring just so I can manage my investment portfolio and figure this stuff out.
Right, no. And you don't wanna
So,
do it yourself typically
no,
because you're
no,
gonna you're gonna
you
end up
know,
making costly mistakes.
and one of the things that we offer through Case Central is a found money report where we're
Oh,
taking a
yeah.
look at, we take a look at their tax returns for the last couple of years and actually put together an analysis that says, okay, this is how much money we have to work with, where we can look at either a Roth conversion or creating some other tax-free stream of income later on in life for those people that truly think that they're not going to need the money. You are one critical illness away from needing that money a whole lot more than you realized.
Sure.
And in the event that you pass unexpectedly, I mean, people die in car accidents every day, crazy things happen. The other tax burden that you need to think about is that generational tax burden.
Sure.
And if you've got a lot of money saved in those pre tax accounts, anybody that inherits that from you that is not your spouse, with the Secure Act that was passed in 2019, they only have 10 years to liquidate that account and pay the taxes on it. So you're adding a tax bill to your kids that you may not have ever intended to do.
Well, and you don't wanna leave your family with a tax burden, or that ticking tax time bomb, because if you leave them a traditional IRA, they've got 10 years to take it all out and pay all the taxes on it, and why
Right.
leave them with that? But you just talked about one of the bigger solutions right there, what you do to help people pay less to the IRS, especially in retirement, is to create a tax-free bucket
Mhm.
of income for retirement. And you alluded to one way, or referred one way, and that's Roth. Do a
Mhm.
Roth conversion, get a
Right.
Roth IRA. That can be helpful for a lot of people in the
Right.
right situation,
It
correct?
can be, but the Roth IRA, again, when we're passing it on to heirs, still has that 10-year rule. You might not have the taxes associated with it,
Yeah,
but you're
that's the
still
good part.
forcing them to do something with that money.
Right.
There's other products and other tools on the market that are available to us as licensed agents and fiduciaries that John Q. Public can't go to an insurance company and say, "Hey, I want this." They're like, "Awesome, who's your agent?"
Yeah.
Because, again, just like you don't self-diagnose medical issues or
Right.
really shouldn't self-diagnose, at least the big ones.
Yeah.
Um, and heaven help me, I'm thinking of Monty Python. "'Tis just a flesh wound,
Just a flesh wound.
just a flesh wound." Working with a fiduciary gives you the opportunity to really explore so many options that you may not have even known were available to you, and
Mhm.
can help preserve and transfer wealth generationally while minimizing that tax burden, not only for yourself, but for future generations.
Yeah. And there are so many strategies to reduce taxable income, but it depends on how much you have, what your time horizon is. I know with Roths, there's a 5-year period. You have to
Right.
have the Roth set up before you can access it. So, that might not be a good solution for somebody who's older, or it depends on when you need the money and what the money is for, right?
Right. And, there are other tools outside of a Roth conversion that give us a whole lot more latitude and multiple different ways that we can use the money, and ways where we're actually multiplying that money over time.
Sure.
Something like a good, well structured cash value life insurance
Yeah.
policy.
Cash value life insurance.
And
Yep.
I'm not talking about whole life insurance, because whole life
No.
insurance is very expensive and doesn't always build an advantageous cash value.
Right.
But when the policy is structured properly, you have a death benefit that you can access to help cover the cost of long-term care if you need it. You have the cash value that you can access to have money tax-free later on in life. And you have a death benefit that you're passing on to the beneficiaries. That death benefit is tax-free
Yeah. Nice.
and can
Yeah.
help offset taxes on those pre-tax accounts that end up getting passed on.
Yeah, a lot of people use insurance policies like that to pay taxes on other things. If you know you're going to have something taxable, you use those policies. But I love these new hybrid policies that will
Mhm.
help, that you can actually access the death benefit while you're still alive if you need that money for long-term care. I love that.
Right.
Yeah.
Why go hunting with just a hunting knife when you could take a Swiss Army knife with you and have several different tools in the same space as
Right.
just that one blade?
Yeah. There you go.
It's about giving us tools to use as financial professionals to help you create that tax efficient retirement, give you that peace of mind, and help cover a lot of bases with
Yeah.
one tool.
Yeah, and you have to do the math. I know you really look closely at, okay, am I better off paying tax, getting the tax break now, or should I pay taxes now and have a tax-free income bucket in retirement? Depends on your situation, depends on your tax bracket, and you talked about working within the tax brackets and then using different tools like
Mhm.
cash value life insurance or a Roth. There are so many different aspects to this, but people heading into retirement thinking, I don't need to worry about taxes in retirement. No, that's a big part. I mean,
We have
taxes and
all been
healthcare are the two big things you're going to have in retirement. I
and
mean,
we've all
that's it.
been told that we're gonna pay less in taxes once we retire
Yep.
because 'cause we're not making as much money.
I used to hear that. I used to think that myself.
Well, I mean, I remember my grandparents talking to my parents about it when individual retirement accounts were first legislated and became a thing.
Yeah.
So, that was the mindset that everybody had, but
Yep.
I have yet to meet somebody who retires and has their mortgage company call them and tell them that they're cutting their payment by a third because 'cause they're retired now.
Yeah, no, doesn't happen.
Doesn't happen.
Nope, your bills are still there. Your
Mhm.
expenses are still there, your lifestyle is still there. Quitting your job does not, necessarily reduce your expenses that much.
No.
It's just a fallacy. So you need to have a solid retirement income plan in place that includes a future tax plan. So
Yep.
how can our listeners out there do that so they can pay less to the IRS?
They can call our offices at 913-553-6222. Select option 4 for appointments and scheduling. Get an appointment to come sit down with one of our fiduciaries and find out how we can start laying the groundwork to help you create that tax-free retirement or a tax-efficient retirement. Tax-free is what we all aspire to, but it takes a
Sure,
lot of work to get there.
sure.
Or you can always go to our website, bgwealthmanagement.com, and hit the contact form there. On the homepage, there's a button that says schedule a consultation. Makes it really easy for you to get on our calendar and meet with one of us because, we've all worked so hard for what we have here in life. And none of us envisioned a retirement where we were excited to pay more taxes.
Yeah, no, definitely not. And again, that website is bgwealthmanagement.com.
Yep.
That's B as in Barb, G as in Gullen, wealthmanagement.com.
And if you like this podcast episode, we've done several other episodes about a tax efficient retirement.
Yep.
You can always go to anchoryourretirement.com and there's an archive of our podcasts there, or go to your favorite streaming platform and you'll find them all.
All right. Sounds great, Barb. A lot of great information packed into today's show. Listeners and viewers, I encourage you to pick up the phone, give Barb and her team a call at 913-553-6222 if you want, or again, bgwealthmanagement.com. Barb, great show today.
Thanks, Tony.
Yeah, good
It's good to
seeing you
see
again.
you. It's been a while.
Yeah, it has. Listeners and viewers, thanks for tuning in. That does it for today's episode of Anchor Your Retirement.